Hi everyone, this is David and Parker with the Gellner team of Kidder Matthews. We're here today to provide an update on Q1 retail investment sales in the Pacific Northwest.
Definitely. Well, always good to be here. I think to start, we've seen a lot of news with tenant closures, Walgreens going private, Joann. What other tenant movement are you seeing, and kind of what can folks expect on those closures?
Good place to start. So this quarter, Q1 of 2025, we've seen Walgreens get taken private. A likelihood that we're going to see more store closures in the pharmacy space for 2025. Big Lots, Joann's, and a handful of others, specifically on the medium and big box segments, which those all get lumped into. That's where the primary vacancy rates are coming, similar to last year and moving forward to this year. I think the biggest guidance we can give is if you own or are looking to own one of those spaces, but specifically if you own a tenant like those, highly recommend getting out in front of it as quick as possible. Mm-hmm. Just to get feedback on what tenants could be potential backfills, and then specifically when you're re-tenanting a medium or big box space, and especially a pharmacy space like a single tenant freestanding pharmacy, the tenant improvement costs are substantial, and we've seen it range anywhere from $500,000 to $1 million pretty easily, depending on the condition of the space, who the incoming tenant is, and how much tenant improvement allowance that they will be requiring.
With those closures, obviously more square footage is going to hit the market that's available. How do you see that affecting the market as a whole? And then for somebody who owns inline strip, should they be worried about that?
It's a good question. Great question. I would really bracket those as just different asset classes almost altogether. We're all in retail, of course, but specifically medium, big box, pharmacy, freestanding stores are completely different than your average shop space or multi-tenant space. Or even, like an example would be, we've seen Jack in the Box close down about a dozen stores so far, just in the Puget Sound region. That's a completely different segment. So like with the Jack in the Boxes, we're seeing those spaces and that type of single tenant with a drive-through. That's still the hottest space to have in the market, and we're seeing those get backfilled extremely quickly, and usually at a lot higher rents than the former tenant was paying.
I agree, and I think something else we've seen a lot of is, even this time last year, developers or anybody didn't really know what to do with these former drugstores, and starting to see a lot more creativity in that space, aside from the typical backfills of ethnic grocers or grocery outlet or something like that. We're definitely seeing knockdowns or prospective knockdowns on just brand new developments there.
Yeah, the positive with the pharmacy space, majority of those locations are fundamentally strong or great real estate, usually hard corner that's signalized, and they have those, most of them have a drive-through. So there has been good tenant activity to backfill those. The biggest challenge we've seen helping clients out is just the cost to get a new tenant in place when you factor in all the expenses like tenant improvements, etc.
And if somebody has fear, or they're kind of planning for the future, if their drugstore does either move out, go dark, whatever it may be, what's your advice to those people?
If I owned a drugstore right now, or a medium or big box, I would just be reaching out to a local leasing professional or a leasing professional in general, just to get out in front and understand what a current market rent is and what a potential cost to re-tenant, just so you're prepared. And then also by making contact with those leasing professionals, you're on the radar, they're on your radar. And so the tenants that are entering and exiting markets changes all the time. And so the more that you can stay on the pulse of that and out in front of that, it gives you a lot higher success ratio.
Definitely. And the other thing our team's been doing, I think we've ran 5 of these so far, is a sell versus hold analysis with a drugstore, comparing the income stream for however much terms left on the lease to the income stream of a 1031 that could be a lower cap rate, but retaining value on kind of an all-in equity plus rent all in value in essence to see, if the store does go dark, it potentially erases all that high rent that you would have been receiving for 5, 8 years, whatever it may be. And it's definitely been illuminating for a lot of our clients.
Totally.
With, kind of segueing into the drugstores or kind of, good real estate, where do you think the hot markets are right now?
Yeah, we've gotten that question a few times this year from clients, so we figured we'd talk about what are the hot markets in our opinion, or what are we seeing. I think in Washington State specifically, Kitsap County, Bremerton, Silverdale, Port Orchard, Paulsbo, all those markets in Kitsap County. We were just out there for a couple days visiting and meeting some clients. That market is on fire right now with new development, specifically multifamily. Tons of new construction, housing, and multifamily being developed. And the source of that and what's changed over the past 10, 20 years with Kitsap County is they moved over a aircraft carrier from Everett, Washington, over to Bremerton, Washington, which increased the amount of families or individuals in Kitsap County by like 15,000 overnight, maybe more than 15,000. So that's driving a ton of that housing growth, and retail always follows rooftops. So we're super bullish on that market this year and seeing a lot of new tenant activity. The other market shifting down to Oregon that we've seen is Beaverton, specifically Cedar Hills. We're seeing a lot of movement outside of Portland core a lot of movement from Portland, the city core, to outside the Beaverton for jobs and housing, etc. REI just moved their headquarters out there. So Cedar Hills, we've seen a ton of new housing growth and a lot of tenants push out to those markets.
Definitely, yeah. Cedar Hills, there's a new development there that's got, name a trendy brand and it's there. They got Salt and Straw just went in, Bamboo Sushi, got a new Shake Shack, Dough Zone. It seems like, those are kind of always the tells on, where all these tenants think there's going to be, high value. And a lot of those tenants you'd find in U Village.
Absolutely.
So it says a lot about
it's
that area.
It's pretty cool.
Mm-hmm. With going back to Kitsap and the aircraft carrier, do you see that as relatively stable? I know I've had clients in the past say, well, if they ever move something out, it could be a problem. But in my opinion, they put so much infrastructure in, it's definitely a pretty stable, clientele that's now moved out there.
Yeah, there's been rumors for years about what's going to happen, and I think as this aircraft carrier move has shown, no one knows, and typically it takes a lot longer than people think, but I think the probabilities are very low that it's going to be going backwards moving forward, or any time within the next 5 years, I would guess.
Definitely. And so zooming out as a whole, we've just compiled and gotten all of our data for Q4 comps that, we track data incessantly. What did we see, or what kind of trends did you see from last year going into this year?
I think the biggest trend we've seen from analyzing every retail investment sale in the Northwest, specifically Washington and Oregon, for the first time ever, or at least going back 10 years, we've seen essentially the same amount of single tenant sales and multi-tenant sales. Usually in the past, especially the past 10 years, single tenant retail sales has really led the pack as far as volume. Typically we've seen 50 to 100%. So, more sales. So usually it's about double the single tenant sales versus multi-tenant. And I think that's just a root cause of what we've been talking about the last 2 years, which is the available amount of land or potential development in the Northwest is a lot slimmer than other parts of the country. And then just the cost to develop has gotten so high that new construction hasn't made a lot of sense for developers. And
do you think, or what percentage would you give to the difficulty to develop versus the buyer pool, seeking? I know we said it last quarter as well, but we always see multi-tenant now being extremely sought after. Do you think there's a driving factor where people just like multi-tenant more now?
I think multi-tenant, that's a great question. Multi-tenant has definitely seen an increase in buyer demand the last 24 months for sure. And specifically with those groups, we're seeing a lot of groups come from other segments of the commercial real estate industry. So hotels, gas station owners, office with those headwinds, and even apartments, where typically apartment owners would typically always focus mostly on single tenant passive investment. Now they're also looking at multi-tenant because the triple net leases, and a lot of those groups, a lot of those other segments, again, don't have triple net leases. So we're all experiencing rising costs. Specifically, insurance expenses are out of control right now, especially on the apartment side. And so I think that's what's driving a lot of that multi-tenant demand. The other reality is we have, under 4% vacancy rates. And so if you take out the medium and big box from that segment, we're probably sub 3, maybe 2 in the 2s for shop vacancy. There's just been little to no shop vacancy, and we're seeing rents go up. So things are really, really strong in multi-tenant land. So I think the biggest driver, again, for the single tenant, why we've seen the volumes for each separate asset class equalize, and specifically single tenant come down volume wise, is one, the development. A lot of those sales in the past were driven with new development, but the other standpoint is we've seen cap rates rise roughly. Obviously it's always case by case, but let's just say we've seen cap rates rise 50 basis points, so half a point across the board from true peak pricing. Well, when you own a single tenant property on these long-term leases, your rent increases are anywhere from 8, 10, maybe best case 15%. So if you're an owner who has bought a single tenant property, held it for 5 years, you take the increase, but then you have to factor in a 0.5%, 50 basis point increase to cap rate, you're almost the same price as what you bought it for usually. And so then you factor in cost of sales, and you're going backwards. And so that's prevented a lot of sales, continuing to drive the single tenant.
Yep, I agree. I've had multiple of our clients say they, who didn't invest in retail previously, that, they're now looking into it because they see the value of being able to pass through those expenses. They know, the all-in cost for the tenant might go up, and that could, potentially down the road prevent larger rent hikes. But in the short term, it's really nice to know that if insurance skyrockets or your taxes come back different than you expected, that can get passed through. I mean, in Q4, there were 24 single tenant sales that we tracked and 24 multi-tenant sales. So directly even, where, to your point previously, it would always be 2 to 1, single to multi-tenant.
Absolutely.
Anything else you think our clients need to be aware of? Market shifts?
I think just in general, we still have seen, especially comparatively to apartment sales. I mean, maybe we'll touch on just apartments. We're obviously retail guys, and that's what our focus has been for 15 years, is purely retail. But I'll just mention, we're seeing a ton of apartment properties hit the market, probably more than I've ever seen in 15 years. And why I mention that for our retail clients and being in retail is typically the apartment side is the best, or some of the best, buyer pool for retail assets. So they're transitioning from, like we mentioned, non-triple net lease type asset, management heavy asset, to retail, which is less management intensive, and then the triple net. So, I would just mention that as we're seeing a ton of apartments hit the market, if we assume that, at least half of those sales get done, there's going to be a surge of 1031 exchange buyer activity, which will continue to either hold pricing firm, which pricing has been really strong for retail assets because of the low inventory. So I think we're going to see a lot more exchange buyer activity heading into Q2, Q3.
I agree. Yeah, we keep in really good touch with our apartment team, and they've got a lot of listings right now for sure.
Yeah, absolutely. And if you have any questions on this video, or if we didn't cover something retail-wise that you'd like to know about, please reach out to Parker and I anytime. We're happy to help. And thanks for watching.
Thank you.